Hello, everybody. Chris Lester here. I'm going to be your presenter this week. This is Thursday, December 3rd, our weekly chat with Chris. So this question, do you think taxes in the future will be lower, the same, or higher? I'm going to now just shift for a second to a website. If you've never seen this website before, this is a lot going on. But in the upper left-hand corner is this country's debt. $27 trillion. I have been showing this clock. You can go to usdebtclock.org for close to 15 years now. And when I first started showing this clock, it was between 5 and 8 trillion. And I was shouting from the rooftops. It is amazing to me the uncontrolled, unregulated spending that our government has implemented. And, and as a country, so 27 trillion, this number here, 85 trillion, includes all household, business, state, local governments, everybody, right? So when we think about it, most of us can't even fathom how large of a number $1 trillion is. And 27 trillion doesn't even include the COVID relief package of $6 trillion that passed earlier this year. Now, I don't know about you, but you don't need to be a math major to know that with only $3.5 trillion coming in from tax revenue, we have a little bit of a shortfall. And if we ran our households like the government is, for a lot of you that put into the chat, hey, yes, I think it's going to be higher, I agree. I think there is no choice, and I'm going to make some case here for you to follow along. So as I switch back to the presentation, I just wanted to give you real-time data so that you could look at that, so that if we truly believe in our heart of hearts that everything that we were been told, that when we retire, while we're working, we're making more money, our taxes are higher, but when we retire, the taxes will be lower. I don't know that I believe that to be true anymore. And if you start to believe that not to be true, then is saving money in tax postponed or tax deferred vehicles like IRAs and 401ks, does that really make sense? So, I normally, spend a little bit more time, and when I'm doing tax planning with the client, we really do look under the hood. But here I just want to keep it. I don't want you to get the deer in the headlight look. I want you to understand on a high level our tax system. So this is for a married couple. On the left side of the column or the screen is a graduated cylinder depicting some numbers and some data. This was our tax environment before the TCJA, which was the Tax Cut and Jobs Act that ended in 2017. And in 2017, it went to the right side of the screen, which was 2017, 2018, 2019, 2020. And you see a red arrow in the upper right-hand corner. And here's what I know for a fact. Regardless of the administration, that on 12/31/2025, the tax environment that was put in place on the right side of the screen will sunset back to the left side of the screen. So let's apply some math to that. Let's just say that you're a couple making roughly we'll say $63,000 a year. That would put you in a marginal tax bracket of 22%. Overnight, on 1/1/2026, if all things remain the same, $163,000 of income will move you to a 28% tax bracket. That's just a given, bar anything in between now and 2025. Now, the other thing that can happen that a lot of people, I've talked about it at my presentations in the past, but if we lose a significant other, right? If we're married, in this case, married filing jointly, now we would file as a widower and eventually you would file single, right? So that also would create a possibility of taxes being higher in the future. So this gentleman here, David Walker, I was first introduced to him back, like I said, in 2005, 2006. New Jersey 101.5 used to do a road to financial success, and they would bring in speakers and you could speak on topics. And I was one of the speakers that would present to, a room full of fellow New Jerseyans, and I would play his video. And I mean, I've been screaming this from the rooftops, but David Walker, he's head of the government accounting office, right? When he worked for the government, he was on the board of Social Security. He's basically the country's top CPA, the CPA Hall of Fame. He's been the comptroller general for 10 years under both the Bush and the Clinton administration, both sides of the aisle. So with that, the thing that he said, in his opinion, and I think this is really, really compelling, regardless of what politicians tell you, any additional accumulations of debt are, absent dramatic reductions in the size and the role of government, basically deferred tax increases. Unless we begin to get our fiscal house in order, there's simply no other way to handle our ever-mounting debt burdens except by doubling taxes over time. Doubling. I mean, you think I just showed you our marginal tax brackets, and he's talking about doubling. So one of the graphs that I've shown folks, and when, a lot of people, when they're saving and they're working and they're saying, hey, listen, I want to have money. I've worked for a company, and $1 million is that magic threshold. If I can just get $1 million, I feel like I made it. And it is a lot of money. The question I will always ask is, how much of that money is yours? And most folks will say to me, well, all of it. I said, not so fast. There's a lien on that account. And whether it be 22 or 24%, right, that you have to pay tax on, and that's not even including state. So now there's a lien on that account. So spendable dollars to you is now $760,000. But you see that green line in the middle of the page? That's the average since our income tax's inception. Our income tax was first created in 1913, and it was designed to be a temporary tax. And that temporary tax first started out at 7%. But it's been as high as 94% in this country. Now, I'm not going to get into all the details of the past tax history, but just understand that things tend to gravitate towards the means, right? So that green line. So if our highest tax bracket right now is 35%, but in this example, 24%, if you listen to what David Walker is saying, doubling would now take that to 48%, still not be at the mean. And we've just lost $250,000 overnight due to tax risk. This is why when I'm talking to folks and helping them to strategize, it's called tax bracket management. Tax bracket, risk management, or mitigate the tax risk, right? That we want to turn around and help you to unravel. And that's why I titled this presentation today, what can you or should you be doing? Is it possible to divorce the IRS? And the answer is yes. Can't be done overnight. Divorce is an ugly word, but the taxes that are due here, this $240 right now, $480 maybe in the future, are not additional taxes. That's just money that hasn't been paid yet. So as we're looking at our overall holdings, what are you currently doing to distance yourself from this in the future? And there's strategies that you can be taking, right? I just had a call with a client this week, and we were talking about, he's charitably inclined, and should we use the COVID relief or the CARES Act versus qualified charitable distributions, right? There's different ways that we can disarm or, start to unravel the tax components that are available. So this is a lot. There's 4 pages. And basically, let me summarize. In the last 30 years, our government has changed or updated the tax code over 40 times. That's just alarming. One thing that is for certain is change. When the government needs money, they are absolutely going to go after the one area where they have not, or there is no lobby to protect. See, if we raise our income taxes, everybody's up in arms, right? And we go, oh my God, I'm working, I'm in a high tax bracket, and I'm being penalized because I'm out working. Okay, right? If the government needs money, what I've always found is that there is no lobby for 401ks and IRAs. And quite often when they adjust or edit the tax code, it is this area that they typically will go after to help to fill their coffers. So I've been doing a lot of marketing since COVID has happened. And I've been on LinkedIn, and I'll reach out to folks on LinkedIn and I'll say, hey, if you'd like a second opinion, I can help you out. But they'll say, I have an advisor. I'm happy with them. If anything changes, I will let you know. And almost to a one, I will turn around and say, I would expect that you do. Because most people that are high income earners, right, have some type of advisor. But the question that none of these advisors, when I ask the client this, is what is their plan to help them to divorce the IRS? And I get crickets, nothing. Because they're all talking about rate of return, rate of return. I don't want to lose money or fees, right? Those are secondary. I mean, rates of return are important. I believe in rate of return. We need growth. Fees, right? Nobody can invest for free. But at the end of the day, if you're managing your own assets, but you keep just throwing coal into the fire, into these tax deferred accounts only to have it paid at a higher tax rate later, you could have made a small mathematical error. Now, I've done another video, if you want to go watch it, it's called The Horse Race, where I talk about the different tax environments, whether it be, tax now, tax later, or tax free, right? I would encourage you to go watch that. I have that either on YouTube, my website, or you can go to LinkedIn and watch it. But it's okay to get a second opinion, right? If you currently have money in these accounts, or let us do an evaluation, right? Let us see if there's anything you can do, right? We talk about those marginal tax brackets. Sometimes there's enough room to be able to pull money out and not change the current tax rate. But that all needs to be calculated based on your specifics. You cannot listen to what I call water cooler advice, or your next door neighbor over the fence that says, hey, this is what I did. You should do this. Because every single decision, whether it's Social Security, when do you claim it? When do you start to pull money out, or RMDs? Should you take it now or take it in the future, right? All of these different areas of taxation affect how much money you get to keep and to spend. So if you'd like a second opinion, right, just circle back with the person that invited you on this call, or reach out to me. More than happy to help you to figure out a solution here. Here's our disclosure, right? Our disclosure just says my opinions are not necessarily those of my registered investment advisory firm. And then lastly, I want to thank each and every one of you. Please stay safe. Next week is going to also be a good one, because you're going to see next week, I'm going to talk about de-risking your portfolio and start to take some risk off the table. There's some indicators out there that I think you should see and pay attention to. So again, look forward to seeing you, speaking to you. Have a great day. If you need anything, give us a call. Chris Lester, Professional Planning Services. Bye-bye.